Welcome to the fourth in our ongoing series of quarterly updates on the National Council of Real Estate Investment Fiduciaries ODCE Index. Pleased to say that more than 400 participants have signed up to sit in and watch today's program, which is about 100 more than our last sessions. That's great. So thanks for signing up and thanks for tuning in. Just to refresh your memory, if you're new, ODCE, as you all I think know, has become the benchmark for so many of you who are watching today. And we therefore thought it would be helpful to start producing as a public service a regularly scheduled quarterly update on what's going on with ODCE, what's happening with property investment fundamentals at the fund and property level, and where the index is likely to be headed based on where those fundamentals appear to be trending. So as you know, there's no charge for attending these webinars. They're kind of a public service from IREI. Now, as always, we welcome questions throughout the presentation. And to pose a question, all you have to do is use the Q&A feature. Just click on the icon at the bottom of your screen. And just to be safe, what I'd like you to do right now is just look down and find where that Q&A feature is. So when you're ready to post a question, you know where to click. Again, it's the little icon marked Q&A, surprise, surprise, at the right-hand part of the bottom of your screen. But during the presentation, I'm going to be monitoring these questions and then popping them over to Garrett, our speaker. And I'll do my best to pose all of the questions that you pose, but keep in mind I may not be able to get to all of them. And any that we miss, we'll try to answer in a follow-up email sent to all of the participants after the webinar. We also will be sending a link to the recording of the webinar to everyone who logged in today and sat in on the presentation, as well as to everyone who registered who wasn't able to log in today. So you can go back and check it, share it with other people later on if you want. Our presenter for these webinars is Garrett Zdolshek, as always, who spent the first 10 years of his career working as a senior consultant for Cortland, which is now part of StepStone. And Garrett was one of the 3 members of Cortland's investment committee and was involved in approving all client recommendations and consulting relating decisions, many of whom had to do with ODCE rated funds. He also has been a member of NACRE for his entire career, and for many years he served and continues to serve as a member of our editorial advisory boards. For the past 6 years, he's been a member of the leadership team at IDR. And as a senior portfolio manager of IDR's investment programs, he's invested in virtually every ODCE fund. So he obviously needs to be an expert on ODCE and of what's going on in the ODCE universe. In fact, ODCE is all he focuses on. So I can't think of anybody more qualified to talk about this subject. We should note again, for the 4th time, that our plan is to produce a video presentation, Garrett, which we'll post to our 2 websites that those of you who aren't all that familiar with ODCE can use as a primer to fully understand what the index is all about. We just haven't been able to get to it yet because our plates have been pretty full, but we will eventually get to it, so stay tuned and watch for that. Meanwhile, please allow me to introduce you all to Garrett, who's going to lead our program today. Garrett, thanks for joining us.
Thanks for having me, as always, Jeff. Great to be here, and I'm excited for the mid-year update here. Maybe with that, I'll kind of jump right into it. I think, the difference this time around is we're actually going to have some polling questions as well. So everyone's invited to please respond. I think it's kind of there's a lot of transitionatory or kind of views out in the market today, given the changes. So love to hear everyone's view here. I think each quarter we kind of try to think of a bit of a theme or something to describe what happened in the quarter. And so on the agenda today, I think is a strong second quarter, over or almost 4% total return, and really thought we'd take this time to kind of review year to date as well as quarter to date information. So as usual, we'll follow the agenda, update on ODCE, dig into the property type and fundamental performance, and end it with a review of the capital flows and kind of state of the overall market. So with that, I'll jump right into the kind of ODCE year to date. So these numbers on this page will be year to date, what's changed from January 1 to June 30. And the top line numbers you'll see are relatively unchanged. A few more properties in the index, occupancy is slightly up. Number of funds, another fund entered the index last quarter in the first quarter, as we mentioned. So no new funds in the second quarter here. And with the value going up, leverage has gone down slightly. I think more importantly are the property type changes. Specifically, office is down to virtually 30%. Apartments and industrial are up, as you would expect, and retail is down as well. We look over time, we probably think retail is probably going to end up closer to 10% over the next year or two. And certainly other is getting a lot of attention. We'll talk more about that other bucket, but continues to increase. And I think it's probably not fully reported as there's others in office, for example, or apartments. And we'll talk about that some more. Regionally, the top line numbers, the West actually continues to be the market of choice for acquisitions, or maybe another way to say it is the East seems to be, and the Midwest seems to be the market of choice for sales as well. So slight changes, but the West is continuing to gain ground over the East, certainly. Digging right into the performance numbers, again, gross top line numbers, the index did almost a 4% return for the quarter. I think more surprisingly, if you look at the 1 year, 8% total return over the past year, when you think about COVID and all the impacts on performance that did happen, still quite a strong period of time to own private real estate. And as we look forward, I think, the returns are that strong total return, I think will be another topic, next quarter as well here for the third quarter. As it seems like we're seeing some pretty strong numbers come in already. I've talked about this in the past as well in terms of, going forward after a cycle. The past 3 cycles, not including COVID, we really saw strong total returns, 13, 14% over the 1 and 3 and 5 year. And while we might be slightly below these numbers this cycle around on the 1 year, we're not probably going to be all that far off. The year-to-date return is around 6%. And as we look at how quarters roll off, I think we're setting up for a much stronger 1 year return going forward. Index overall is up to $280 billion in value, which is actually 3 times larger than it was just a decade ago. So as we kind of dig into the appreciation numbers in history, the actual ODCE appreciation for the quarter was 2.9%. And that brings the 1 year moving average back to where it was really pre-pandemic, right around 1% appreciation number. So about 2% total return. I think the last thing to note is valuations are now, as a whole, certainly not by individual property type, but as a whole, ODCE valuations are actually back to peak values in 2019 pre-pandemic. So I think by general measures, that would say we have gone through the cycle and kind of are on the other side for now, at least. The valuation changes by property type, again, drilling down even further. And a reminder, these are unlevered appreciation returns. So no leverage, no fund impact. It's clear industrial is driving the way. But when you look at kind of overall, and think about these on an unlevered basis, leverage has been a pretty accretive factor over the last year, and has probably driven these returns by at least 50 basis points plus on a levered basis for the accretive property types here on the left. 56% of ODCE is now in what I would kind of term strong performing sectors, industrial, other, and apartment. And I think it was quite remarkable, really, how quickly the weightings did change. And that's really what's driving performance here. So, office is certainly lagging. And if you really even drill down into the subtypes, CBD office actually depreciated by about 0.5%, while the suburban office was actually up about 1%. So again, top line numbers don't always tell the full story, but overall, the index is really being driven on the left-hand side here. And I would point out retail has come pretty close to bottom, it appears. Over the last quarter, retail is basically flat overall, and over the last year it's only down 1% now.
Now, Garrett, somebody's asking, what is included in the other property type category?
Sure. So a couple things. One is NCREIF actually going through and doing a big project to reclassify the subtypes within these different categories. For example, years ago, if you look at historical data, hotel was actually broken out. It's now part of other, but there's only a couple assets in the whole index there are a couple hotel assets that are still in the whole index. So other today is primarily self-storage, student housing, some life science, although again, some life science is also in the office category. And then also there is some for rent residential, single family for rent residential in other, but it can also be included in the apartment subtype. So that's why I say I think other is a probably artificially low categorized view in NCREIF at the moment. But they are going through a process. I think the goal is to kind of be done with it by year end. And really get more scientific about the exact subtype classifications.
That was Tim Wang's question. You can ask questions, by the way, either with your name, where I'll mention you, or anonymously, where I'll just simply post the question. The next question is from Craig Blanchard. He says, Garrett, do you think retail and office ODCE valuations as a whole reflect private market values? Seems like ODCE managers have been slow to reflect write-downs.
Yeah, so I would disagree with the ODCE managers being slow. I think it's a nature of the asset class to come to complete values and accurate values. I would also say they're probably slow to write up assets as well. So as I look, and we can always point to a specific asset and individual deal, but as we look across the index, and I'll talk about this more in the acquisition disposition summary, but as we look across the index in terms of assets being sold around carrying value, meaning plus or minus 1 or 2% within carrying value, that's happened. So largely the assets are being sold that are sold around carrying value. Now, that's a small majority of the overall assets, certainly. But at the end of the day, I think if you look at public markets overreaction and probably ODCE's slower reaction, it's probably somewhere in the middle of the two, is what I would argue. It'll be a never-ending debate, but I think the managers and the appraisers are doing the best they can in both directions, but they do need comps and they do need to look a bit in the past to see where values should be.
And how would you compare the performance of ODCE that we're looking at right now to the performance of, say, a Core Plus funds?
Yeah, look, I think it's a broad generalization again that ODCE is a low levered, stable, index, and it's meant to be a baseline index of what you can achieve in the private real estate markets in a core fashion. if you look at history, I think the data shows you that core plus with more leverage generally outperforms in up cycles and underperforms in down cycles. So I don't really think core plus funds necessarily fit in ODCE, but I think they're a complement, where ODCE is a complement to them. And I think you get different outcomes based on that.
Okay. And I've got another one from
Sure.
Yusahisa Chujo. After COVID-19, capital flows to ODCE core funds were negative for a couple of quarters. What are the backgrounds and outlook in terms of investors' investment appetite moving forward?
So this one, Jeff, how about we cover this in the capital flow section? Because we do have a whole kind of information and details on that.
Okay, so Yasuhisa, we'll get to your question, but we'll handle it a little bit later down. Okay?
Absolutely.
All right.
Jeff, maybe I'll just kind of summarize kind of these last two questions in terms of kind of valuations and property types. As we look at ODCE, I really wanted to show, this chart showing the property type kind of movements over time, the weightings over time within ODCE is, I think it's really even been surprising to us how fast industrial has caught up, if you will, to some of these others, and how quickly office has come down as well. On the far right-hand side here, you can really see how industrial, residential, and office are starting to converge, right around that 25 to 30% mark. You also see it's really come at the expense of retail. And I think that's been two things, retail write-downs, industrial write-ups, and then the buying and selling of the underlying funds as well. So, I think you're going to see those three property types only get closer together, most likely. And I think you're also going to see other, really come up here, especially depending on the recategorization of certain assets. That could actually lead to a lot bigger other number as well.
You think, so, Garrett, do you think, looking at retail, it's been on a downtrend, as your data clearly shows. Can we get back to that slide for a second? Just sure. to show how the weighting in the index has changed over time. But it really has been, for the longest period of time, really one of the anchors of the ODCE portfolio. We're going through a lot of turmoil in the retail sector. Certainly the pandemic has stressed it a lot. Do you think this is a permanent change, or do you think this is a temporary change and eventually it'll gradually move back up, or who knows?
I think as you look at retail, it's a mouthful because there's so many different types of retail as well. Everything from, on the extreme, right, the fortress malls, where I think are great real estate, great locations, very infill, all the way to, a non-grocery anchored strip center, with second and tertiary tenants now, and maybe doesn't have that much of a reason to exist. So I think the focus is, as all real estate comes down to, is location and productivity of that location, for its intended use. With that, I think retail is just a less safe place to be for investors at the moment. But to your point, it was the best performing sector for quite a while. It was best performing sector during the great financial crisis. And it really, I think it will come in favor again at some point. Okay. Maybe in a different way though, or different use to a degree. Office is another example. It was almost 40%. It was just under 40% of the portfolio here in 2015, 2016. And again, those cash flows, I think, are being questioned to a degree, and investors are seeking, more stable long-term cash flow.
I've got a couple other questions. Sherry Santos West says, where does manufactured housing fall into these categories, if at all? And then along the same line, does retail cover malls as well as grocery anchored retail and other retail property types in ODCE?
Yeah. So the first question, manufactured housing largely falls under other today, although it can be classified as apartment or for rent. So I think it's a bit of both, but it is a very small percentage of ODCE. And we'll also talk, for rent, single family residential kind of falls in that category as well. And in 2020, we saw the first deal by a fund, and there are now a number of funds pursuing those strategies. Again, maybe $500 million of total value in a $280 billion, portfolio, if you will. So not big, but certainly a new place that people are, viewing as an attractive location right now.
So another question from Scott Cohen. He says, hey, Garrett, could you break down what you're saying within the industrial space? Is the outperformance broad-based or is there a continued geographic skew?
Yeah, so by geographic skew, I guess, are you asking if it's just kind of Inland Empire, West Coast outperforming everything else? I would tell you the weightings are what's being bought is, significantly West Coast biased, but the industrial is broad-based. The outperformance is broad-based. If we actually look, across the market, oftentimes, you can see where if you bought the right apartment portfolio, that would clearly outperform, a bad office portfolio. But vice versa, if you bought the right office portfolio, you could still outperform. That's not the case with an industrial. As we look at it, the worst industrial portfolio in the index is outperforming every other property type. So it's very broad-based.
Yeah. Okay, great. Now, after COVID, well, we'll get to that question, right, a little bit later.
Yeah. So how about we just jump, Jeff, I think we also kind of touched on the retail performance, and this is a cross retail. And actually, Sherry Santos, I think you had a question about what's in retail. It's everything. It's grocery anchored apartments all the way to malls. And as we look at it as a whole, it does appear retail is coming to an equilibrium, if you will, in value. This is unlevered again. So asset level unlevered data. So if you look at it, these retail in ODCE is down 19% below peak value, which actually happened in 2018 pre-COVID. So retail started declining, even before COVID came about. Neighborhood retail, which is largely grocery anchored, has definitely been a better performer. Values declined. Actually, they had a positive value increase this quarter, about 0.5%, along with community. So, I think, this has largely been a mall decline, although all retail has gotten caught up in that. Malls, I believe, don't quote me on this, but I think malls in ODCE are down about 28% compared to that 19. So overall, retail is basically flat for the quarter, though. When you look at income for the year, retail is actually slightly up 0.9% for the whole year, if you include income. So I think it is, my view only, I think it is bottoming. Could we bounce around slightly here a little bit? Absolutely. But I don't think we're seeing these big value shifts any longer. To Craig's point earlier, retail REITs are up 33% for the quarter, or I'm sorry, for the year so far. So year to date, retail REITs are up 33% this year. But again, they were down more last year than ODCE. So I think, apples to apples, they're actually, getting fairly close in value.
And Michael McNamara is asking, would you know what percentage of the retail pie is in malls versus other? Rough, I mean, not maybe precise, but some rough idea.
Yeah, so it's moving. And the reason I hesitate is I think kind of pre-valuation changes, if you look back to that kind of 2018 number, I think malls were about 40% of the overall retail value in ODCE. I think today, and one of my associates, Brian's on the phone, on the call, who knows this offhand, but I think today, I want to say it's about 25% of the overall value is mall.
Yeah, I think Brian responded to Michael and typed his answer as well. Ed Schwartz says, Mr. Zdolshek, why is the retail income return still so low? Is it cap rates or is it vacancy?
Yeah, so, they both, right? So they both, I think it's a great question. They both impact each other. And if you kind of look at the value change, you would think the cap rate should be much higher. But yet that's been, I think, muted by the income collections and kind of these starts and fits and starts of restarts with the consumer going back to the stores. So I think, if you look at what's trading and the income and the cap rates off of that, I think what you'd find is the income is much higher, but on a trailing basis, it's pretty low still because of the COVID impact. So I would expect to start seeing better income numbers going forward, or higher cap rates off of retail going forward. But I think it might be a bit of an artificial number at this point.
Okay, thank you.
All right, so Jeff, this is our first poll-in question. We're going to give people a couple, 30 seconds or so to answer these. So we're going to keep these moving fairly quick. But this is actually for the group. Does the group think retail values are nearing a bottom in valuations? So I think it'll be fascinating to hear the group's response here. Yes, they're at a bottom. No, they have a lot more to go, or not sure. And I probably shouldn't have ruined it, Jeff, by giving my answer first, but
well, you're assuming that you're much more influential than you may be. We'll find out.
I don't think I'm assuming that. All right. So, okay. So interesting. So just about half of the group says we are nearing a bottom. About a third, 31%, says we're not. And about another 20% saying, who knows, which I think is a fair answer too.
Yeah. Okay.
Great.
Thank you. Thank you all for voting.
Yeah, absolutely. And we'll have a few more of these. So, and we kind of delved into this a bit, but the property type, and we'll talk a little bit about subtype as well here, but the green line is the best performing sector performance in any period, and the gray line is the worst performing property type sector. And the blue, the dot is ODCE as a whole. So you can certainly see the different cycles, but you can also see how differently property types can perform. And we are at an all-time high. This is even higher than what we saw in the GFC in terms of the divergence of return between today industrial and retail. What I thought was even more interesting, though, is when you look at the subtypes within these property types, that I think really tells the full story. And as you start looking at different periods of time, certainly you can see in the GFC, for example, how great malls were. that was retail really holding up and the malls, not changing in value. Where at the bottom, that even lighter gray is hotel, actually. So, not a big part of the subsector, obviously, to move the needle a whole lot, but it did perform even worse. So I think, when you look at this wide dispersion, just the property type alone doesn't necessarily tell you the whole story. And you can really see there are meaningful differences in terms of, getting that apartment, high rise versus garden, subsector selection right as well. So that'll take us to the next polling question. Why, today, I think there's a big focus on other and specialty property types. So I'm kind of curious with the group, what's the number one reason you're interested in these non-traditional property types? Is it diversification, higher income, perceived higher income, maybe perceived higher total return or expectation at least? Or are you not interested in these secondary types? But, we certainly see a lot of it in the news. So we'll give it a few seconds for everyone to respond here. Jeff, what do you think?
I would think it's going to be different for different people, which is what the thing shows. I mean, I think people are worried. I think also, which wasn't one of the answers, one of the options, but people are concerned about the traditional property types being able to continue to perform. There's been a wall of money chasing them, and cap rates are at all-time lows, and they see some of these other property types as having different characteristics that they can exploit and take advantage of. It's interesting because for years and years, there were really only three main property groups, and then apartments joined them, and there were four. And most of people's core portfolios were built around that. People seem to be broadening tremendously their definition of what constitutes a core property. So that's kind of interesting.
Yeah, no, look, I agree, right? Years ago, even in ODCE, someone wouldn't kind of expect to add a traditional property type without years and years of discussion and research. And now I think it's viewed more as, hey, look, this is a great way to, and we saw the polling question, right? I think half was about total return, right? Finding return outside of beating, hopefully the benchmark, right? I assume. And then I think you saw, to your point, Jeff, a significant portion of the people were saying, look, I want more diversification in my portfolio. I don't know which way things are going to go anywhere anymore, so I just want more risk spread out across all these different property types.
Yeah. We have a couple of other questions. One is why alts? Option 5, because you can only put so much in industrial and multifamily. So I know that's not a question, it's a comment. We're saying, you can only put so much in the traditional property types, so people are looking for alternative places. But again, the interesting thing is, in the past, they would consider those alts, and now they're considering them part of core, which is, I think, a big change in sentiment.
Yeah.
Another question is,
yeah, how does the valuation gap close, right? So if you, and this is going to be one of the polling questions, is, where's going to be coming up? So where's going to be the best performer in 2022, right? We know 2021 is pretty much played out. I think industrial won, but these values going up on one hand and down on another, I think to a degree are fundamentally justified, but generally the market will overreact or react longer. So I think two things will close that gap. One is fundamentals, will they change, or will they come back into more historical norms, meaning, less retail risk on the downside and less industrial, option on the upside, if you will, in terms of rents. And do those fundamentals change to a degree? But then certainly buying at a 6 cap versus a 3 cap, just fundamentally, you got a lot of appreciation to make up at a 3 cap, and I'm not saying everything's a 3 and a 6 cap between industrial and retail, but fundamentally, do those income numbers change substantially over time? As a whole, on the income side, I think real estate still looks pretty attractive compared to the public markets, and especially the bond market, as a proxy. And I'll talk more about, I think, real estate's role in the broader portfolio. But, as you look at historical cycles and performance, these are the last 3 cycles in yellow. Real estate generally follows the bond market. The public markets are generally first and faster. So if you look at kind of where we are today, real estate being the blue line, and bond spreads being the gray line, bonds are significantly below historical average spreads. So the black line is the historical average spread for each sector, the triple B spread or the real estate spread, the treasuries. Real estate's still above historical average, and bonds are significantly below average, and they go both ways. And I wouldn't be surprised to kind of continue to see real estate, migrate down towards that bond number.
Now,
and it looks like this.
Along the lines of something we were talking about earlier, you mentioned that Core Plus may be a complement to ODCE's core property type. How do you view the increase in niche sectors for core funds? And, I made the comment that, people are looking at it as core. Do you think it is core, or do you think it's something alternative that's being added in to boost you?
So, I think some of these niche sectors will be core sectors over time, and I think you'll get compensated for being early. I also think some of these niche sectors may turn out to not be so core, and you're going to not get compensated. In fact, it's going to be the opposite result. We kind of saw this with hotels. I think that's the most prominent example of that, right? Where hotels were part of ODCE. They were viewed as a return enhancer and generator above core asset values, or, and returns. And investors have largely said, every downturn, these things have generally been worse, and they've added volatility to my portfolio, not taken it away. So I think some of these sectors will turn out to be great. And I think, they'll be part of ODCE long term. But I don't think ODCE's role is to necessarily give investors, 50% exposure to other day one. I think it's to be kind of slower moving and more stable for them. And it's a great way to potentially outperform or get higher returns.
Well, along the same lines, somebody asked, how long of a runway do you think many of these alternative sectors really have? Some of them become pretty expensive, and arguably they may never scale the level of the major sectors, which means they'll continue to become expensive. Too much money chasing too few deals.
Yeah, look, I totally agree. And I think it's a very case by case, subsector analysis, right? If you look at for rent residential, single family for rent, I think it has a ways to go potentially if you can scale it. The question is, can you scale it? And I think some have, but long term, will it prove to be more of a hotel type of experience or more of a, apartment type of experience, and again, I think that's the individual investor's, hard job, right? That's the hard part, but I think you'll see some of it in ODCE, and I think the managers will prudently dip their toe in the water see how it performs. And if they like it, they'll do more. If they don't, they'll look at other stuff like life science or whatever.
Okay.
Actually, so that does bring us to a bit of a transition and a couple polling, questions here. I think at a macro level, there's been a lot in the news lately about perhaps a slowdown or, prices taking a pause at least. But there's been certainly a lot of news out there about, this is a temporary pause. Wait till, the corporations start pushing prices again, towards year end. So I think number one question is, and again, if we can pull up the polls, the question is, do we believe the Fed in talking about rising inflation as being more of a transitory event here, or do we think it's a longer term change? And I think secondly, that answer really impacts, question number two, where's the place to be to hedge against inflation? If it's shorter term, I could argue certain allocations, and if it's a longer term, I could certainly argue more hard assets. So kind of curious to see how these two answers play into each other with the larger group.
Great. And while they're doing that, just keep in mind we've got about 19 minutes to go, just so pacing.
While we're waiting, I will maybe pull up the next section, which is cash flows and capital flows to the sector. So the results, interesting. I would almost say it's fairly even based on the polling numbers, but a little over a third saying yes, and slightly more saying no to the transitory inflation. But I think there's a good group saying who knows. It could be a bit of both, probably. I think related to that, the second part is, and we are real estate people, so I appreciate the bias, but real estate really has been a pretty good inflation hedge, although we haven't seen inflation, real inflation for a very long time. So, again, I think that does point a bit to, a bit where we are in the cycle relative to the other asset classes as well.
Yeah, it'd be interesting to see if we could pose the same question to group CIOs, see if they come up with the same decisions, and see when they have their hand on the throttle when it comes to asset allocation next. So.
Absolutely. A lot of real estate people become CIOs, though. So net cash flows to the sector, and this is the highest level of cash flows, if you will, where we include everything. So everything from income distributions, income reinvestment, it is clearly an inflow, whereas distributions are an outflow, and then Qs as well, and what's paid out of those Qs, not what's waiting for those Qs. So this is real time, money coming in and out of ODCE funds. And I think what's most interesting, I've talked a bit about this in the past, was, how much bigger the sector is and how much more liquidity there is in the overall sector. If you look at kind of the 08, 2010 period, you really saw those cash flows come down significantly, both in and out, where the market really froze. It didn't happen nearly to the same extent during COVID. And you can also see how much bigger these cash flows are getting, post-COVID, almost $6 billion coming out, over $4 billion going in. And so, I think this also shows the kind of transition real estate's played of being a more cash flow generating asset rather than a total return asset, maybe in the last cycle, where investors are really more relying on real estate to produce that income check every quarter for their beneficiaries, more like a bond alternative today.
Okay, there's a question that really refers back to the prior slide. It says there's always a debate about the relative merits of investing in ODCE versus NAREIT, private versus public. It might be a bit sensitive, but NAREIT has generated outperformance over ODCE for short and longer term horizons, 10, 20, and 30 years. Is the advantage of ODCE over publics the lower observed volatility?
Yeah,
and also understanding is that sector compositions and leverage is likely different between ODCE and NAREIT.
So, yeah, I think this is the never-ending debate. It's anonymous, so I appreciate it. I joke if you're part of NAREIT, but every time ODCE has up years and NAREIT has down years, we see research how core actually private outperforms public, and every time we see the public asset class go on a run, we see how public outperforms private. This is highly time period dependent to say that public outperforms private or vice versa. And so I would tell you, if you look at various periods of time, they do switch. They change, and I think you're getting two very different outcomes. You either want equity exposure or you want private asset exposure. That's decision number one, and based on that, you're going to have a very, very different ride. It's, do you want that big roller coaster, the tallest roller coaster in the world, or do you want the kiddie ride? End of the day, they seem to end up pretty close to each other.
The way I always answer that is it's kind of like asking what's better, a wrench or a screwdriver. They're different tools for different purposes, and they're both valuable to have in the toolbox. They both are useful, but doesn't mean one's better than the other. Screwdriver is no good for turning a bolt, and a wrench is no good for turning a screw. There's 15 minutes. There's about 15 minutes to go, and somebody said, Tom Taylor asked, please, on how multifamily managers are dealing with the national state eviction moratoriums.
Yeah, so I spent a lot of time looking into this actually, and talking to a number of ODCE managers about their portfolios, because we're really not seeing any impact in the data, which surprised me. Meaning collections are back to historical normals. There is always some delinquency in apartments, but we're not seeing anything out of the norm. So when you look at kind of these eviction moratoriums and who it's really affecting, I saw there's about 6.5 million delinquent families or delinquent rental checks due in this country today. And over 75% of those are to mom and pop landlords defined as owning 4 units or less. So, I couldn't really get into or delve down further to understand if that's more workforce housing. My suspicion is yes. But my suspicion is also this is not traditional institutional management, landlord tenant relationship kind of effect. So, I know we see it a lot in the news, but when we look at the institutional impact, we're seeing virtually no impact. I don't even want to say we're seeing an impact because we're not in the numbers.
Well, this is a follow-up from Thomas. He was saying, thank you for your answer. Obviously, you're tracking these things. Are there any recommended articles or online news sources or some place that he can go to continue to monitor the same topic that you're monitoring?
I can send you over a couple articles, Thomas. I tell you, I kind of put our research team on it to do two things. One, see if we see in our data any impact on rental rate and effect. So we can certainly show you that. But from the national perspective, we just had our research guys kind of dig into where is the impact really happening with Reese and some other, frankly, or pay data sources.
If you want to send those to us too, Garrett,
Sure.
we can post those to our website so people can download them if they want to.
Yeah, happy to.
Okay.
Since we only have a few minutes left, Jeff, I'm going to skip the polling question and I'm going to go right to transaction summary because I think this is kind of top of mind, what's happening in the market, at the asset level. And, overall, there are about $3.5 billion of dispositions in the quarter. Actually, about the same number of acquisitions as well, but I'll start with dispositions. Office was the biggest sector, largely CBD office. Actually, we saw about $1.5 billion of CBD office trade this quarter, which I thought was pretty interesting given the rhetoric around office not being able to trade. And this was big office, so I think that's a positive development in terms of coming to, seeing valuations. The other thing was retail. It's only 13%. It was about $500 million of retail. And again, this was largely at book value. So, I think it's positive. We are seeing some transactions, mostly grocery anchored, no mall. But again, at least it was book value and we are seeing transactions. On the acquisition side, no surprise, industrial, and this was heavily weighted to the West Coast markets in California specifically, but certainly apartments and other trailed. Apartments were almost exclusively Sunbelt locations, and other was largely the manufactured housing, single family rental. I think there's a life science asset in there as well. So a little bit of everything in the other category. I think last time we had a bit of a question about, where are the dispositions going? Who's the buyer? So we spent a little time thinking and looking at that too. And it's really a mix, as we looked at this quarter, it was, I think, core plus institutions and funds saying, hey, in the office sector, we're buying below replacement cost. We see some opportunity to put some money in these assets and, make probably above a core type of return. It certainly wasn't core funds buying this office. And then I think on the apartment side, it's really almost anyone looking for a store of value, whether that be a super high net worth family, or foreign, or even some institutional saying, look, with inflation, with fundamentals, I feel just safe putting money in an apartment right now.
Does the transaction summary shown include M&A transactions? Max Berker wants to know. Cooper.
Not sure what that means. This would just be ODCE owned.
I would think they mean like when you're acquiring companies, like somebody acquired a portfolio through a platform.
It would include portfolios for sure. Yeah, I don't think there were any public kind of company transactions here, meaning whole companies sold or bought, but it would include like a portfolio of assets being bought or sold.
But there might be a company like a Red Hill, which is an operating partner that might sell. Not that they're not. But that's not included in these figures?
No, any asset that's owned by an ODCE fund would be in these figures.
But ODCE funds typically don't hold operating companies, right?
No, exactly.
Okay.
That's why I say it could be a portfolio, but it wouldn't really be an operating company. This is just ODCE assets.
Okay, makes sense.
Jeff, we are coming up to the hour, so I'm just going to skip to the last main, page here, which is Qs. As we've been tracking this and showing this since COVID, kind of the impact of COVID on Qs. So anything happening before this didn't count, if you will, in these numbers. You can see the Qs are coming down, the exit Qs. A handful of funds are orderly paying out some Qs. really don't think it has a lot to do with their performance, frankly. I think it has to do with some of their investor types and kind of just normal rebalancing type of things at this point. On the other hand, though, the entrance queues are actually bigger than the redemption queues. So, kind of as we expected and predicted, more money is coming to the space. The actual is backward looking that I showed before, whereas I think this is more forward looking. These ODCE funds do have capital. They are buying, and I think they're going to be buying a lot more based on these queues. So overall, I think, again, it just probably points to some positive returns for ODCE. You kind of look year to date, we're at a 6. This third quarter, I think people are going to be surprised on the upside again. I think some, funds reacted a little faster than others to valuation changes maybe last quarter. So there's a little catch up this quarter. But I think also the fundamentals are supporting these changes. So overall, I think, certainly double digit return for 2020. I just question whether it's kind of a 13 or closer to a 10.
So that kind of answers the question that Lisa had asked early on regarding the fact, what's the investor appetite look like? If you're starting to see entrance queues exceed exit queues, then it tells you that investors are feeling bullish and have an appetite for continuing to invest in ODCE type funds. And I think that would be consistent with what we saw in our investor survey results earlier in the year. But everybody has been constrained by their ability to underwrite new investment opportunities because of COVID. That's starting to change because some investors are starting to travel, not a lot, but some. That started, and then it slowed down a little bit because of the introduction of the Delta variant. And then the other thing is a lot of investors are starting to experiment with virtual due diligence underwriting, with drones and other type of devices to do their underwriting. So things are changing. And I think, as we move on through the year, assuming that we don't hit with another wave, I think you can see the pressure relieving and people traveling more and a lot more money flowing in, because there's certainly a lot of pent-up capital that hasn't been invested yet. At least that's what our surveys are showing, and what our capital fundraising results are showing out of our IREIQ database. Now, there's a question from Jennifer Stevens. She says, if available, can you please share a chart showing these net capital inflows in core and core plus? I don't believe that is available, is it?
Let me dig into the research here. I can find out.
Okay, so Jennifer, we can get you something directly. And then again, if we have a good answer to that, we'll post it in our email when we send out the links to everything. We'll post that answer to everybody. And if we have a piece of a chart or something like that, we can include it in that.
Yeah, I think it's a great question. And I think part of it is probably how you define core plus. It starts to core plus, value, core. It's all, I think to a degree fungible depending on, the definitions. But, Jeff, to your point, definitely seeing more flow pick up, across the board in real estate, private real estate as a whole. And I think we're going to kind of continue to see that as the market opens up. We're even seeing live conferences again. So, I think
we did one we had our first editorial advisory board meeting since the original lockdown last week, and had 20 investors, 10 consultants, and 30 investment managers show up. And universally, the response from everybody was delighted to be there. They just were so hungry to connect with each other. We were real careful in the way we staged it. Most of the events were outdoors. We asked people to wear masks if they're unvaccinated, if they're indoors. We're only indoors for a very small fraction of the time. But people had a blast. It was just so much fun to see people coming together to connect with each other.
Yeah, no doubt. And it only points to the Sun Belt and the West Coast more and more, right?
Yeah.
Well, Jeff, those are my prepared remarks. As always, I really appreciate you having me, and we'll get these materials out, but look forward to seeing you again next quarter as well.
Thank you, Garrett. Really always appreciate the amount of preparation that goes into this. It's not easy to pull all this data together and then to think about it and be able to speak authoritatively is really a blessing. So thank you. And thank all of you for tuning in and for the more than 24 questions you guys gave us today. Great to see that audience interaction. I hope you like the polling, different twist. See you next time. See you next quarter. Take care.